Well, what is the biggest risk in property investment? Could the real danger be the opportunities we pass up? And how can professional insight make entering the market a lot less daunting? Well, to dispel common myths and offer a deeper dive into Australia's varied property scenes and discuss how to stay cash positive even as interest rates rise. Richard Sheppard, CEO and founder of inSynergy Property Wealth Advisory, joining me now in the studio. Thank you very much for being on the program. Look, we were chatting before we went to air, and I think it's very interesting that we talked about the opportunity lost when you don't do anything, as in when you don't start investing. So tell us about this opportunity cost, if you will.
Yeah, thanks Tessa, and thanks for having me here. It's a real privilege. Yeah, absolutely. So I've been advising for about 23 years now, since leaving the army, and investing for a long time before that. And most people don't understand how to invest really safely and how to get into a market that is near the start of the boom, and how you can find property that is almost always or always positive cash flow. So most people have borrowing capacity and they're completely underutilising it. So when you understand how to invest in property safely, to be honest, the answer about how much you should invest is what your borrowing capacity is. And so many either don't do any property investing or nowhere near as much as they can safely. And so that's a big part of our passion and job, is to help people make really informed decisions so they can understand that. So they're making the decision for themselves. It's not just being told or advised to do something. And then that way they're really empowered. They're excited about what they can do, and then they can make more informed about how much to do in a really practical, risk-managed way.
Yeah, and I think to your point where you say that investors need to invest safely, and I think that's what happens when you read a lot, you try to research, and there's some analysis paralysis. And this is where I suppose someone like you would come in. So in this interest rate environment that we're looking at, okay, someone comes to you, what would be the very first steps that they have to do and get into a position where they can be investing safely?
Yeah, so is learn, really. The very first step is learn. Be passionate and make learning a priority. It's really interesting how busy we allow our lives to be, and often we don't put our financial future as a high enough priority. So come and learn. So we normally spend an hour or two for free with people, just teaching them about these core concepts, how the markets move, how to identify when a market's about to start its boom phase, and how to use equity, how to set up cash reserve buffers, and how to manage the cash flow of property investing really safely and effectively.
So there are broad strokes. I know that there's no one size fits all, but there are broad strokes and core concepts you're saying that can apply to everyone, a general term?
Absolutely. It's the core concepts are largely the same. The first one is learning. You'll hear me say that a lot of times, and that's a forever process. It's keep learning, enjoy the process of learning. But when you learn about how property markets move, property is an inefficient market, so there's a lots more opportunity to identify when a market is about to boom. My job is about 10 to 50 times easier than most financial planners and the fund managers, because they're all lots of smart people competing in a listed market where they have to use publicly available information or it's insider trading. For me, my job is in an inefficient market where you can identify far bigger trends and make far bigger returns just with better research. And it's really interesting. The markets that are about to boom are usually the ones where their yield is high, their cash flow is higher. So you'll get higher returns usually with lower risk. Assuming you're in the strong, diverse markets like capital cities and not a mining town. And that's really, there is a cycle largely caused by human behaviour. There's some fundamentals as kind of the groundswell, but when you understand those key drivers, and then you learn how to use equity and how to keep cash reserves as buffers, you can do it really safely.
Can we flesh that out? So you said you can tell, for you, the markers of a potential upward trend are when you see yields starting to go higher. You said human behavior. What about that? And can you give us specifics so that people watching would go, okay, these are the things I'm seeing. Perhaps this is the beginning of a boom. Everyone wants to know how to time the market. I know that probably it's not achievable.
It'd be great to pull some graphs up and geek out on this stuff. It's really cool when you see it visually.
So yields and what else?
Yeah, so We normally look for the markets that have performed almost the worst for 7 to 15 years. So all markets have, wherever there are lots of humans in a big city market, they all have a cycle, and it is roughly 7-ish years of flat or poor growth and roughly 7-ish years of boom. Of course, it can be longer or shorter, depends on what other economic factors are driving it. But when the market's going flat in capital growth, rental returns and affordability is increasing. And eventually gets to this point where rent is very close to the loan repayment. So renters become buyers, and that starts the property values increasing. And then the human behaviour really kicks in of that fear of missing out. When somebody finds a place they really like and they weren't quite fully ready or fully confident and they just miss out by $5,000 or $10,000 because someone outbid them, then the next time they find a property they like, they're pushing their hand up, or they're putting in private offers far more assertively. And that's the fear of missing out. And that will start that accelerated capital growth that can go for roughly 7 years before it outpaces rental returns and affordability, and you start to hit that glass ceiling of affordability. And that's largely why there's a 7-ish year cycle.
Where are we seeing that cycle playing out from a point of view of a geographic location in Australia? So obviously capital cities and different regions would have different movements at present. So where are the opportunities where it's about to go up in this country?
So we can share a few secrets, and are very glad to. So, and sorry, I don't like to use the word secrets. It's not secret.
Is it not though? But yeah, go ahead.
No,
we'd love to hear.
Do a little bit of research and talk to the right people. And so the top 4 capital cities in our view, absolutely Adelaide. That's been the number one for about 5 years. But with the AUKUS project happening, $400 billion investment, we think that's going to be a 20 to 30 year boom. All right, so the 7 year sometimes doesn't apply. Sometimes it's 15 to 20 plus year boom. And we'll talk more about that perhaps if we get time. Absolutely Brisbane. Now Brisbane, you would say is 30 to 50% through its boom if it wasn't for the Olympics coming.
I was wondering that.
So that's probably going to make
Did you see a dip after the Olympics?
Oh, it was really interesting. So a lot of people thought that would happen in Sydney.
Oh, but it didn't.
Yeah, and it had another 3 years. It had like a 1 or 3% dip straight after the Olympics, and then we had another surge, about 40 or 50% growth for 3 years.
Okay, so Adelaide, Brisbane.
Yep, Perth. Yep, and the dark horse, which most people won't expect, is Darwin.
Really?
Darwin has probably the best fundamentals of any property market that we've seen perhaps forever. It's not moving yet, and it's really interesting. People don't respond when the fundamentals are ideal. It normally takes 6 or 12 months. So when you look at a per capita basis and the relative affordability compared to Sydney, and so many of these drivers, Darwin will probably outperform for at least 10 years. But Adelaide, probably the strongest for 20 years. Yeah,
I wish we had an hour to geek out on these things. Okay, but I want to ask you before I let you go, how do you stay cash positive while trying to get into investing in property, given this environment, the interest rate environment?
Yeah, so one is when you get into those markets that are starting to boom, the average yield is higher. So Perth has about a 5 to 6% yield on houses and units. Darwin a 6 to 7% yield. All right, that's the long-term average yield. But when you learn what sort of properties can get you a higher yield, there's things like executive letting, there's adding a granny flat, there's dual lock duplexes, NDIS type property, the HMO, the multiple occupancy properties. And these are some really good techniques and cash flow positive property that is also great for the community and a really big need. So getting the right market that's going to grow, that has a naturally higher yield and will grow for longer, and then you can identify if cash flow is really important to you, or most important, which it probably should be to most people. It helps with borrowing capacity, so many things. You can look for properties that fit those sort of criteria.